What I am saying is that when silver does break out, it's truly an amazing financial circumstance for those speculators who can afford it, and those speculators who have the emotional stability to handle the volatility that you can see in the silver market. We've been through a period, 1982 to 2022, by my reckoning, 40 years of tame inflation, a strong U.S. dollar, a strong bond market, strong equities markets, great demographics, where investors had the winds in their sails. And I think that really changed in 2022. I think an accumulation of bad habits over 40 good years, in particular, the tolerance for systemic deficits, the incredible amount of recourse and off-balance sheet liability encumbering the U.S. government, means that the landscape in front of us is different than the landscape behind us. But I think it's fair to say that many of the people who manage pensions, endowments, profit-sharing plans, things like that, are managing for the last 40 years rather than for the next 10 years. Imagine, as an example, owning the very long bond, which is a staple for long-term investors, the 30-year bond. If the interest rate goes up, the capitalized value of your distributions, which is to say the principal, goes down. But if the interest rate doesn't go up and inflation stays high, the distributions, the spending power that you get in terms of the distributions for the 30-year bond goes down too. Heads you lose, tails you lose. In an asset class that's one of the most important asset classes in terms of the constituents of those very long-term portfolios that you're talking about. There has also, I think, been a rewarded preference for large-cap U.S. growth stocks. When one looks at the length and breadth of the U.S. equities market, what one is struck with is the fact that much of the growth that we're seeing in the equities markets is confined to 20 or 30 stocks. When somebody's buying an S&P 500 index fund, what they're really buying is a large cap growth fund. And people need to understand that. I'm not saying it's a bad thing. What I'm trying to say is that it comprises too large a portfolio for most pension and profit sharing plans. And I also think that the lack of breadth in the equities market is also concerning. I need to say I'm less concerned, frankly, about equity bets in the broader U.S. market than I am the long bond. The long bond seems to me to be an almost guaranteed loss. I'm concerned too, and I hope to move on to cheerier topics later. I'm concerned too, with my banker's hat on, about the concentration in the banking industry, and in fact in the pension and profit sharing industry generally, around commercial real estate mortgages. I don't think that shoe has dropped yet. I see buildings changing hands for 20 or 25% of previous highs. And I wonder what happens to a mortgage holder in that circumstance with 65% loan to value. Well, I don't wonder. I know, in fact, what happens. And I'm afraid that if we see another tick up in interest rates, that question is going to be called on a massive scale. The gold price is up from $35 to $2,600. That's less good than you think when you take into account the deterioration of the purchasing power of the dollar. But what gold did over those 50 some odd years is it protected the purchasing power of those who owned it. Fast forward to year 2000. Gold was at what, $252, $255 an ounce? In the ensuing 24 years, although gold didn't spike, and although many people are disappointed inexplicably in gold's performance, it did generate almost an 8% compound internal rate of return. That corresponds very nicely, I think, with the current rate of deterioration of the US dollar, which is to say, you don't necessarily buy gold to make money, although when it moves, it really, really moves. What you buy it for is to reduce the deterioration of the purchasing power of your savings. How much gold you own depends on how much insurance you need. If you own a small business and the product that the good or service that you provide is necessary enough to your customers that you have some pricing power, which is to say, if you can pass on the cost increases that you incur in the price of your product, if you're inflation hedged internally, you need to own less gold. Similarly, if you run an intelligently managed, rationally leveraged real estate portfolio, where inflation increases your rents while at the same time they increase the cost of people building product to compete with you, you have a built-in inflation hedge, provided, of course, that this is intelligent real estate, intelligently leveraged, as opposed to crazily leveraged, and you need to own less gold. But if you're a recently retired physician, you've had a great 40-year run, you have a $5 million retirement, you are spending $350,000 or $400,000 a year to sustain your current lifestyle, and your retirement is mostly in long bonds, I think you're going to have an interesting experience this decade. And I think you need to own enough gold that you can hedge against the deterioration of the purchasing power of the distributions that you'll get from your long bonds. I think it's likely to continue for two reasons. The first is that the U.S. government has weaponized the U.S. dollar. We have used things like the SWIFT banking system and sanctions to constrain the actions of other countries in what is, in effect, the extraterritorial imposition of U.S. values on those countries. They want to transact with each other, but they don't want to transact in U.S. dollars. Whatever you feel about Russia and the Ukraine, when the United States government walked in and stole $300 billion worth of Russian assets in U.S. treasuries, they sent a real message to governments around the world. You can't trust the U.S. government.
I'm sorry, I have to interrupt. That was a real shocker to Rick Rule, wasn't it? Rick Rule never said that on our channel. Go ahead, please.
Well, I don't distrust our government more than I trust other governments. I'm convinced that the most dangerous government is the one closest to you. For me, that happens to be the U.S. government. But it does mean that the global hegemony that the United States dollar has enjoyed as a medium of exchange is slowly being chipped away. It's not going to go away overnight, but countries, particularly countries that have active disputes with the United States, and there's a lot of those, have come to understand that they can't allow the U.S. government to control their trade. The only instrument that they have that they can trade with each other in, because they hate each other's currencies more than they hate ours, is gold. That's a fairly simple circumstance. The other circumstance also relates to the U.S. dollar, which is to say that the U.S. Treasury, which is largely what's being displaced by gold in these foreign central banks, is a lousy deal. Again, let's look at the arithmetic around the U.S. 10-year. They're paying you 4%, where the purchasing power of the distribution is declining by 7.5%. The U.S. government solemnly swears that they will destroy your purchasing power by 2.5% a year, compounded. If you were China and you thought about this guarantee, this is, formerly the best credit in the world is absolutely positively guaranteeing me that my purchasing power will decline by about 30% over 10 years if I invest in their treasury. It's no wonder that there is disintermediation from U.S. Treasury securities to gold among central banks around them. And I think it continues for those reasons, because I don't think that the United States, irrespective of what party gets into power, will have any interest in reducing American hegemony. In other words, I don't think that either Trump or Harris would be content running the United States. I think both of them want to run the world. And the rest of the world has some objection to that. which I think is fairly understandable. The second thing is that I don't think either Trump or Harris will do anything to restrain the U.S. deficit. I mean, Trump makes some promises about the fact he's going to bring in Elon Musk and fire 80% of the federal workers. All anybody needs to do who believes that claptrap is read the book The Triumph of Politics by David Stockman, who was the director of the Office of Management and Budget in the first Reagan administration. And you'll understand what a bald-faced lie that is. So when you have no reduction in U.S. hegemony, which means you have no reduction in the disintermediation out of U.S. Treasury securities for gold for geopolitical reasons, and you have no reason to suspect that the deterioration of the purchasing power of the U.S. dollar will be constrained, the outlook to me is pretty clear. The increasing central bank purchases of silver, which you've correctly documented, surprised me. It isn't something that I've seen before. And I've been struggling. Well, I haven't been struggling. I've been asking people who are smarter than me what it means. And I haven't received a satisfactory answer. Part of it would suggest that foreign central banks are becoming semi-speculative, that they have looked at history and seen that silver has outperformed gold after gold has established a trend. And if they think gold has established a trend, perhaps rather than just defending their economies with gold, they're going to try to make a profit. Historically, the concept of central banks making a profit is a concept that has never occurred before. So I'll leave the efficacy of those strategies to other people. The other theory that I heard is that India in particular, but perhaps India and China too, as a consequence of historic cultural attractiveness to silver, are going to encourage retail savings in their own countries. And so part of me has a trouble believing that, because I think that in India, for sure, silver would crowd out the rupee. In other words, people would go for real money as opposed to government money. Too sweet. And I think that the government might be smart enough to understand that. China might be trying to do the right thing. I don't know. What you suggest, which is to say that we are seeing increasing central bank purchases of silver, is a phenomenon that I've never seen before. And I can only speculate as to its cause. I also, if your listeners will replay earlier interviews that you and I did, suggested that the leadership in precious metals markets needs to be established before gold follows suit.